I think the world's starting to wake up to the fact that we have serious near-term economic issues. And that's why I think gold and silver continue to be buoyed. Now, there are always pullbacks because that's just people pulling back, taking profits or whatnot, consolidating positions. But again, I don't see those prices falling down substantially for any length of time. We could see potentially as gold goes up and as silver reaches its final shortage condition, as it kind of gets there, because we're producing a lot less than we're using right now, you're going to see silver pop. So I think we're getting into that next leg of the precious metals market. We're sort of in the first stages. You could see some pullbacks along the way, but I do not see, given physical demand, I do not see us retreating back in gold and silver for any length of time.
In a recent interview with Liberty and Finance, Robert Kientz, editor and publisher of Gold Silver Pros, discussed the performance of gold and silver compared to other assets. He noted that despite the pressure faced by other assets like Bitcoin and certain stock markets, gold and silver have held up well over the past year. Kientz identifies several key factors that contribute to the enduring strength of gold and silver. One significant aspect is the robust support stemming from industrial demand, which serves as a driving force behind the steady performance of these precious metals. Additionally, the active involvement of major players in the market, including prominent bullion banks and producers, has played a crucial role in reinforcing the market position of gold and silver. Kientz expects that while some financial interests may be shorting gold due to its recent sideways trading, the actions of bullion banks and producers indicate their expectation of a price increase. This speculative price action, combined with heavy physical deliveries and repositioning in the futures market, suggests a growing demand for gold and a potential upward movement in its price. Regarding retail liquidity, Kientz believes that while retail premiums for gold and silver have increased, they have not reached all-time highs. This indicates that there is still enough liquidity in the retail market to meet immediate demand. Now let's watch some clips from Robert Kientz's interview with Liberty and Finance. But before we do, please make sure to watch the entire video. Also, consider subscribing to our channel and turning on post notifications so you never miss an upload. Thanks and enjoy the video.
When you look at the gold market, the swap dealers dropped or they lessened their short position in gold through May 23rd, because this report's done in arrears, so it's a week old. But leading up to May 23rd, that week of data, the bullion banks or the swap dealers dropped almost 17,000 gold short contracts. And also the producer merchants dropped another 7,500. That's 24,000 dropped shorts, meaning both the swap dealers and producers and merchants went net long. Who took the other side of that? It was the financial types that manage money and the wealthy individuals, other reportables. So the bullion banks, producer merchants, the big players in the market are going long gold, and the financial interests are now going short. Why are they going short? Because gold's been sideways trading for a bit. So the financial type said, stock market's going up, gold sideways trading, we're going to dump a bunch of our longs. Well, when you see the bullion banks go long that much in a short period of time, they're expecting the price to go up. So the price action, to me, the speculative price action on the market tells me that gold and silver have a lot of support, and they have it from the industrial side. They have it from the big industrial side. And it's just the financial types who are getting out. They're not the experts, and their exposure is not into gold that heavy. It's a small part of their portfolio. We're seeing people with an immediate demand for gold take their futures position in COMEX and go to London and see if they can get it. And it doesn't surprise me. The first month where we had a substantial amount of contracts available on COMEX where you could get delivery, which was June, people have come in and just really hammered out that market. And as I'm looking at gold, there were more contracts closed on the market in the last 2 days than existed. So that means not only are people closing existing futures contracts, people are coming in and establishing an instant delivery contract where they go take a futures position and it's delivered. And the reason I know that is because the amount of open interest that came off the market was 11,666 contracts yesterday, but there were only 11,092 existing. So 500 and some contracts had to be some sort of instant delivery where somebody came in and just said, I need it. There was a participant in the market that said, fine, forget about the futures. We've got it. We'll sell it. And they matched up, and it was like done on a daily or 2-day basis. That's how much demand was pent up for this June contract. Somebody wanted gold and they came in and got it. And it didn't surprise me it happened, but it surprised me so much happened over just a 2-day time frame. That's really abnormal. I think when we talk retail liquidity, there's enough disseminated liquidity there of gold and silver that the retail premiums haven't just exploded again. They're still kind of high relative to where they probably were the last 20 years on average. and they're still higher right now, but they haven't gone like all-time highs like they had been at certain times in the past. So there's enough to kind of quell immediate retail demand. But I think when you see people coming to the big commercial markets, you're talking big entities. You would be talking like a Mint or a Sovereign or somebody that had a need for tons or, thousands of ounces of gold is coming and buying it. So I think that means people are positioning with gold in their portfolio for the coming recession. And getting back to what we were talking about before and Tavi's research and yield curve inversions, and where we have a yield curve inversion, the big players know that, and they're going to go back to gold as a crisis asset or a safe haven asset. And that's what we're seeing. It doesn't blow up the futures prices because the futures market can deliver a lot of gold without exploding. However, when you get to a shortage condition, the futures markets then have to change their trading approach, because if there's no physical in the market, they can't hold the derivative pricing steady because the risk has changed. So the physical demand is a risk factor that the derivative markets consider in their trading, but it's not till that risk factor flashes red that you start to see the big price movements in the spot prices or the paper. So we're seeing some nice support in the paper. I mean, gold and silver have held up very well the last year to year and a half when everything else has sort of been under pressure.
Moving forward, Kientz believes that gold and silver are still valuable investments, even in our technological society. He argues that gold and silver provide a foundation for individuals that is not subject to counterparty risks or additional derivatives. He suggests that individuals should consider holding gold and silver as part of their long-term investment portfolio. During the interview, Kientz also highlighted the significant increase in gold deliveries on the major exchanges recently. He mentioned that in the past 2 days on the COMEX, 1.5 million ounces of gold were delivered, which is equivalent to approximately $3.57 billion at current prices. Kientz explained that only about 6 months of the year are actively and heavily traded for gold or silver on the COMEX, with December being a common month among them. The choice of trading months depends on the longer-term price movements that traders and investors anticipate. Let's get back to the interview.
Yeah, I think the metals do a lot of things. One, they're a transition. Well, first of all, they're money. I did an episode on my channel which said gold and silver money, everything else is currencies. Currencies can be good for certain things, but they're not money. So if you're going to save in an ultimate asset, you want to get to the asset which is going to retain its value and has lasted for the longest and has stood up against everything else. And that is gold first and silver second being the little brother, because only silver's actually been money a little bit longer in most parts of the world, but right now it's so commoditized as an industrial component that it's hard to use as money because we need it for, everything that we need in our technological society. We're now in technology, silver's needed for technology. But silver will still get monetary demand and the price will still go up. And I think holding that as your ultimate, that's your layer one, first thing you need to do, or at least from my perspective, protection. I'm not your financial advisor, but for me, this is how I view it. Everything else on top of that is either some sort of derivative or has some additional counterparty risk that you have to account for. So yes, gold and silver for me. And also, if you look at currency transitions in the past, it's always been done with gold as like an anchor. So gold will get revalued to allow that new currency to have value. And what will probably happen is they'll issue a new currency along the old one, whether it's fiat or digital, depends upon where we are in their development of the digital dollar. A friend of mine thinks we could go to another paper dollar first until they're ready as a transition, which is why even if the current version of the dollar collapses, they'll probably have another paper one available. Now, that will only work one time. You can only print a new paper currency once, and they don't tend to last very long, but it may give them some runway to get their digital. So I think that's what they're trying to manage. But the thing that binds it all together and it makes any of those systems work is what's underlying it all, which is gold and silver, and they're true money. So I always recommend having some gold and silver because at the end of the day, no matter what they do in the financial system, that's going to retain its value. At least it has over history. Yeah, it was 1.5 million ounces delivered in the last 2 days on COMEX, which is 3 billion and 57 million at current prices, thereabouts. That's a lot because we weren't expecting this month to be huge delivery. There were about 11,000 or so contracts outstanding yesterday. 9,024 out of 11,092 contracts got delivered. That's unprecedented. That does not happen in a single day on the COMEX since I've been covering it. We took 90% of the available open interest and delivered it on the first couple of delivery days of this month. So that means somebody was waiting for a big potential delivery date for gold and went and got it off the COMEX. And off the last 2 days, 9,024 contracts were delivered on the 30th, and on the 31st, it was 6,537. So $3 billion worth of gold in 2 days. And why did they do that? Well, in June, okay, so in the COMEX, only about 6 months are really actively, heavily traded for gold or silver. And December is common between the months, but then they trade on different months throughout the year. Why? It's a futures market. You don't necessarily need to trade futures every month. You're guarding against price changes over time. So it's not like the spot market where I may go buy gold today and I'm worried about the spot price today. And then tomorrow, if I'm a trader, I may want to turn it back in if I'm trading, right? But on the futures market, they're looking at longer term price movements and they're looking at smaller price movements. And it's a leverage market where they're controlling a lot of paper, okay? And so this is a different dynamic in the market. It's a commercial market. And to have that much delivery come in when mostly it's just price adjustments that people are pricing in, when they're buying these contracts to protect against small price movements over big lots of material, big lots of metals, we typically don't see a lot of physical deliveries. The COMEX was not designed to be a huge physical delivery market, honestly. That amount of delivery in 2 days is really astounding. And yes, if you go back to the deliveries we've seen on gold and silver across Shanghai, the London markets, those have been elevated the last few years. Shanghai especially. Shanghai delivers a ridiculous amount as a percentage of the total contracts. It's much more a physical delivery market.
Despite the recent volatility in the stock market, gold and silver have held up well over the past year. This is due to a number of factors, including strong industrial demand, the participation of major players in the market, and speculative price action. Looking ahead, it is likely that gold and silver will continue to be valuable investments. This is because they are not subject to counterparty risks or additional derivatives, and they provide a foundation for individuals that can protect their wealth. In addition, the recent surge in physical gold deliveries suggests that there is strong demand for the metal. This could lead to higher prices in the future. Do you think gold and silver will continue to be valuable investments in the years to come? Please share your comments and observations in the comments section below. Additionally, if you found this video informative, don't forget to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.